Hey, welcome. We've all heard the golden rule of investing, right? Buy low, sell high. But what if? What if you could just flip that completely on its head? What if you could actually make a profit when the market is tanking and everybody else is freaking out? It sounds like something straight out of a movie, but it's a very real strategy called shorting. So, how does this financial magic trick actually work? Let's get into it. You've probably seen the movie The Big Short, right? It's a perfect example of this in action. It's that crazy story about guys like Michael Burry, who basically saw the 2008 financial crisis coming from a mile away. So what did they do? They placed a massive bet against the US housing market and ended up making a fortune while the whole system was collapsing. But what does that really mean, to short something? So, at its core, shorting, or short selling, is pretty much the exact opposite of what we normally think of as investing. Instead of buying a stock and rooting for the company to succeed so the price goes up, you are actively betting on it to fail. You're making a bet that the stock price is going to fall. Think about it. Normal investing is super simple. You buy low, you hope to sell high later. We all get that. But as you can see here, short selling just completely inverts that logic. The goal is to sell high first and then buy low later. I know, it sounds a bit strange, right? How in the world can you sell something that you don't even own yet? Well, let me show you exactly how it's done. Okay, this might sound a little weird, so let's use a really simple analogy to make sense of it all. Forget about all the Wall Street jargon for a minute. Let's just talk about cheeseburgers. Imagine there's a company called Cheeseburger Co., and you've done your homework and you have a really strong feeling their stock is about to go down. All right, so here's the game plan. Step 1, you call up your broker and say, hey, can I borrow 10 shares of Cheeseburger Co.? Right now they're trading at $50 a share. Step 2, you immediately sell those shares you just borrowed. Boom, you now have $500 cash in your account. Step 3, you wait. And just like you predicted, the stock price tumbles down to $30. So step 4, you repurchase those same 10 shares, but this time it only costs you $300. And for the final step, you simply return those 10 shares back to your broker. So let's just recap what happened there. You sold for $500, you bought back for $300. What's left over? That's right, a cool $200 profit. And you made that money because the stock went down. It's a pretty brilliant concept, but it comes with a massive, massive catch. Now, I know what you're thinking. Wow, that sounds almost too easy. And you'd be right, because what happens if you're wrong? What if your research was off, or the cheeseburger company suddenly announces the best burger ever invented? This is where short selling gets really scary. Okay, let's rewind our cheeseburger story. You borrowed and sold those shares at $50. But whoops, instead of falling, the price shoots up to $70. Now, remember, you still owe your broker those 10 shares. To get them back now, you've got to pay $700. You only made $500 when you sold, so you just lost $200. Ouch. And this right here, this is probably the single most important thing to understand about shorting. When you buy a stock, your risk is capped, right? If you put in $1,000, the most you can lose is, well, $1,000. The stock can't go below zero. But with shorting, your potential loss is, and I'm not kidding, unlimited. So, unlimited? How is that even possible? Well, think about it. A stock can only fall to zero, right? That's its floor. So your profit when you're shorting is capped. But is there a ceiling? How high can a stock price go? There isn't one. It can go up and up and up forever. And you're on the hook to buy it back, no matter how high it gets. That's terrifying, and it's what makes shorting one of the riskiest games on Wall Street. Okay, so you're probably thinking, there's no way a broker would just let me lose an infinite amount of money, right? And you're absolutely correct. They've got their own skin in the game, so they have a few safety nets in place to protect themselves. First things first, you can't just do this in any old account. You need what's called a margin account. It's basically like getting a line of credit from your broker. And here's a fun little tidbit from the fine print. When you sign up, you're also giving them permission to lend your shares out to other people who want to short. And number 2, what happens when your bet really starts to go south? You get the dreaded margin call. This is your broker calling you up and saying, hey, you need to put more cash in your account, like right now, to cover these losses. If you can't, or you don't, they will just step in, close your position, and lock in that loss for you. They are not going to let their own ship go down with yours. So yeah, it should be pretty clear by now that shorting a specific stock is a high-stakes game. It's really for the pros. But what if you're a regular investor and you just have a gut feeling the market's about to take a dive? Are there any safer ways to play a downturn? You bet there are.
All right. Option one is something called an inverse ETF. The easiest way to think about this is like putting your portfolio in reverse. It's a special kind of fund that's built to go up when the overall market, like the S&P 500, goes down.
Now, the great thing here is that it's way simpler, and your risk is defined. You can't lose more than you put in. But, and this is a huge but, you have to understand these are for super short-term trades. We're talking maybe a day. Why? Because they reset every single day. Over time, because of the way the math works, their value just kind of decays. Holding on to one for a long time is basically a guaranteed way to lose money.
But you know what? There's an even simpler strategy. It's time-tested, it's what legends like Warren Buffett do, and it involves no fancy products at all. It's just waiting for the crash and then going shopping. Look, history has shown us time and time again that crashes are scary, but they're a normal part of the cycle. You have a peak, things get too hot, then there's a crash, and you hit a bottom, a trough. But that moment when everyone is panicking, that's the moment of maximum opportunity. That's when great companies go on sale. It's not about trying to time the storm, it's about having the cash and the courage to go bargain hunting after it passes. So really, it all comes down to this one question. When you see storm clouds gathering on the horizon for the market, what kind of investor do you want to be? Do you want to be the daredevil making a huge bet against the storm, or do you want to be the patient opportunist waiting for the rain to stop so you can pick up all the bargains? The choice is yours.